Hey FreightWaves Now fans, we are coming back to you again today on Thursday with market expert John Kingston, here to talk to you a little bit about what in the world is going on with oil. John Kingston, welcome, glad to have you here.
Very great to be here. I was here 2 weeks ago talking about oil then. It's like a whole different world already.
Well, you've spent a lot, you have a lot of background in oil. You've covered it like 3 decades, right?
Yeah, thank you for making me feel very old. I really appreciate that.
I mean, it goes way back. No, but it's great to have you on here, and we're talking about not way back, we're talking about what's been happening right now with oil, and I mean, it happened like overnight. What's going on?
Well, I mean, we'll go a little bit back in time. 2 weeks ago ago when I was on, OPEC had just reached agreement to slice 1.2 million barrels a day off the market, 800,000 barrels of that from OPEC and about 400,000 mostly from Russia and some of its allies. So you'd think that markets would be strong, but markets have, the word that traders use is capitulate. When a market just sort of like gives up any kind of, the selling pressure is enormous. So we dropped down to levels near $46 for WTI. We hadn't touched that level since September of 2017. Remember, just 3 months ago, really around 2.5 months ago, it was $70. People were talking about the road to $100 Brent, which is the other main benchmark. And what's happened really is, first of all,
well, like 2 weeks. Give us some context. What were you talking about 2 weeks ago when some OPEC and non-OPEC companies agreed to cut production? Countries agreed to cut about 1.2 million barrels of oil per day.
Starting in 2019, starting next year.
Okay.
But of course, the contract you're trading now is for 2019, January 2019 delivery, now February. But anyway, the fears that global slowdown in growth that hit the stock markets this week have hit the oil markets too. So the projections are that, most projections are that the world will add in about 1.5 million barrels a day of global oil demand next year. Remember, it goes up every year. Okay, the only question is how much. 1.5 million barrels a day, that sounds like a lot. It's not. The U.S. is expected to increase its own production by close to 2 million barrels a day next year alone, which is going to, which will obviously, they can take in, I shouldn't say that all non-OPEC countries are going to be about 2 million barrels a day by themselves. That takes care of all of global growth, demand growth, and then some. So this is the situation facing OPEC. Increasingly, the market doesn't feel that the OPEC cuts are going to be enough to overcome that, and they see growth being simply not enough to essentially suck in all of the new supply that's coming out. And most of the new supply that's coming out is coming from the U.S.
So there are how many, is it 100 million barrels per day of oil are produced right now? Is that correct?
Right now, the market, the world estimate on demand is just maybe a little under 100 million barrels a day, but it's going to get to 100, within the next year or so.
So why would an impact of just like cutting 1.2 million barrels, would that really make a big difference?
Yeah, it doesn't sound like much, but the fact is commodity markets, oil markets like oil markets, are established by the marginal barrel or the marginal unit, or if you took economics in college, the marginal widget, as people like to talk about widgets. So what is the battle? What is the price needed to move that last barrel? Now, if you've got projections of, let's say, growth of 1.5 million barrels a day, and the supply is kind of set to assume that, and in fact growth comes in at 1.3 million barrels a day, well, that's 200,000 barrels a day of oil every single day looking for a home. The price to move that has to plunge to get people to incentivize them to put it into storage. And that's why that marginal barrel, that marginal unit, becomes the most important. It's like, the 99.9 million barrels a day or 99.8 million barrels a day that is the base of the market. They almost don't matter. What matters is that last unit, and right now the market for that last unit is looking very weak.
Now, how is that? Now, you mentioned that the U.S. is going to be like, we're just ramping it up. It's at all-time highs, right? Historic high. So are we trying to balance that out with the production? Or is there a way to counter the cuts?
First of all, the U.S. is still a net importer. Okay, the U.S. consumes more than it produces, so it doesn't really want to do that. It doesn't want to see the price higher. This is not Saudi Arabia. This is not Nigeria. Also, the U.S. doesn't control oil. We talked about what the U.S. is going to produce. The production is coming from hundreds of companies making their own decisions. So there's no central authority deciding what the U.S. is going to do.
That makes a lot of sense. And of course, as we're looking here at the ULSD, what is it? The ultra low sulfur diesel rack price right now of oil, as we can see just in this about 1 month of data.
Yes.
It has gone all the way down to 1.843. What does that stand for?
That'd be cents per, well, dollars per gallon.
Okay, dollars per gallon. So as we can see from our sonar data, it is low. Also, another thing, we're talking about supply chain and how does this affect like the diesel market and prices in that. And we have a page pulled up for that as well, right?
Well, this is we have the diesel price. I think the other chart we have is the U.S. production.
U.S. production.
So you can see what's just been amazing. So now up to about 11.6 million barrels a day. Going to be up past 12, average up past 12 next year. So you were coming from a year ago down around 9.5 million barrels a day. You've tacked on 2 million barrels a day. It's just an amazing story.
So what is happening with diesel right now?
Well, diesel had an interesting week this week because the weekly Energy Information Administration statistics that come out every Wednesday that the market looks at pretty closely showed two things. It showed a tremendous draw in diesel inventories, number one, and it showed really strong demand for diesel as well. You know, when economists look at oil markets, the ones that really understand energy, diesel is far more important than gasoline. Diesel is considered the fuel of the economy, the fuel of commerce.
Oh, wow.
So you always have to watch whether diesel is starting to expand its price advantage or price spread over gasoline and its price relative to crude oil. This week, as weak a week it was, or as I hate to say low, but the declining week for oil in general, diesel actually sort of held in there, and a lot of that was because of that EIA report on Wednesday. That spread between crude oil and diesel always has to be watched very closely, because we're getting toward 2020. In IMO 2020, a lot of diesel demand. There's going to be a lot of demand for what's known as marine diesel out of the maritime sector as they try to clean up their fuels. And this has some people very, very nervous. So I look at that diesel to crude spread very closely because I think it's one of the most important things going on. I think what happened this week had nothing to do with IMO 2020, but I think you did have, for all the talk about slowing demand and slowing economies, the fact is the diesel numbers this week showed a pretty strong economy.
Well, we will keep an eye on what's going on, but that is what's going on right now. Thank you for tuning in to another one of our daily casts here of giving you the latest in what's going on. And thanks for that awesome information on oil markets, John Kingston. We release our new FreightWaves Now video every day at 4 o'clock. Check us out on our site or on Twitter or our various social media sites. That's it for now. Stay safe out there.